By way of background, I started my career on Wall Street at Citigroup as a credit risk analyst focusing on financial institutions. I made the move to the Wall Street Journal because I felt a disconnect between what was being reported and what I felt was actually happening on Wall Street. As a producer on CNBC's Squawk Box, I was fortunate enough to have the unique opportunity to work with David Einhorn at the time of his very controversial Lehman Brothers call. I met with other managers, learned about the industry and their strategies, and most importantly, their passion on their trades. Reading books like Market Wizards and The Money Masters, I too wanted to write a book like this, but on hedge funds, the Alpha Masters. I decided to profile each of the major hedge fund strategies and the managers emblematic of each. For example, John Paulson on event arbitrage, Ray Dalio on global macro, and Sonia Gardner and Mark Lazary on distressed investing. It's an honor to welcome Sonia here today. Sonia is the co-founder and president of Avenue Capital Group with over $12 billion in assets under management. She's one of the few women in the industry to have co-founded and managed her own firm and has over 20 years of experience in the business. She's also on the executive committee of the board of the MFA and 100 Women in Hedge Funds. Thank you for joining us. To start off with, Sonia, why don't you tell us a little bit about how you started Avenue in 1999 with Mark? I think you two are the only brother-sister operation in the industry.
I think so. Not exactly sure, but I think so. We actually started working together in 1989, and we had formed a small partnership where we were essentially managing money for Cowen and Company. We were doing distressed investing, one of the few people in the industry that was actually doing it at the time. We then left and formed our own brokerage firm, which was Amrock Investments. It was essentially a boutique distressed shop, and we did that and built it up to about 50 people. So in the beginning it was just me and Mark and a secretary. In 1995, we decided that we wanted to essentially hedge ourselves because the brokerage business was getting very competitive. Goldman and Lehman, Merrill, everybody was setting up a distressed desk. So it was no longer a small niche business. So we started Avenue with $7 million in 1995 and built it slowly. In 1997, we did our first institutional fund with TPG. And then in 2000, we made the decision to essentially close Amrock and focus exclusively on Avenue. So it wasn't something that was planned. It was something that just really developed over time.
You had said that you would spend sometimes 12, 14 hours a day in front of a copy machine on legal documents. You never thought that you went to business school. I went to law school for this, right?
Right. Well, when we first started in the late 80s, you had to actually go to the bankruptcy court and make your own photocopies. So the first person to do it, and obviously being a first mover was a very big advantage. So we used to fly around the country, go to bankruptcy courts and copy the schedules and stand there with a bag of dimes and literally stand there, like you said, for 10 hours. So, I mean, at this point, everything is online and it's much easier, and there is no mystery to how that part of the market works. But we started by doing just trade claims and bank debt. So, in the late 80s, it was us and I think 2 other people.
And now you're one of the world's largest distressed investing firms.
Yeah.
So in the beginning, how much time did you spend focusing on infrastructure, and why was that important to Avenue from the outset?
Well, when we started in 1995, we were lucky because we actually already had an existing business, which was Amrock. So we actually had some capital to put in to the infrastructure of Avenue. And our feeling was that if we were going to do it, we wanted to do it right, and we wanted to actually have the infrastructure in place before we went out and started trying to raise a lot of money from people other than, just family and friends. And in 1997, when TPG took us out, which obviously was, for us, it was like a stamp of approval to have TPG say, this is our distressed person that we want you to invest with, and they owned a piece of the GP, and over the years the partnership developed to a point where they formed their own distress shop. Obviously they have TPG Axion now, but in the very beginning TPG was really a large part of how we raised money, and they taught us that the infrastructure was really important. And from our perspective, we didn't want to have to raise the money and then build the infrastructure afterwards. I think that's the backwards way of doing it, and it's not the responsible way to do it. And I think that's how a lot of people probably failed in the beginning, because they were great investors, but they didn't have the infrastructure, and then something blows up in your back office, and that's it. The institutional investors are gone at that point.
So you really feel like that helped put Avenue ahead of the curve with developing business faster, getting investors to feel more comfortable faster, all of that?
Yeah, absolutely, absolutely. Because we actually started just with a U.S. fund, and then in the late 90s we formed our first Asia fund, and then about 5 years ago we did our Europe fund, and each time that we started a new business we did it the same way.
Do institutional investors pay more attention right now to due diligence than they did before the crisis? How has that changed with dealing with investors?
Yeah, I think that, everyone in this room who's involved in a fund knows that you're probably spending 4 or 5 times, more time with them. I think that it's completely understandable from their perspective. The crisis obviously brought up a lot of questions in terms of how some people were operating their businesses. Obviously, I think Madoff scared a lot of people. And what's happened is there's a lot of requests for more transparency. There's a lot more visits, and they want to actually go over your risk policies and your compliance policies and actually meet a lot more people than they used to. And from our perspective, it's great because we do have a great infrastructure, so it works. I think that what's difficult is for smaller firms that don't. I would assume that it's much more difficult in terms of trying to meet all the demands that they're making.
In his opening remarks, Jayesh spoke about the need to compete for the future. At Avenues, what tactics are you employing now to make sure you're ready from that operational perspective? Or is it just a continuation of business as usual?
Yeah, I think it's something. We don't ever get to a point where we feel, okay, operationally, that's it, it's over, we're done, and there's nothing else to be done. I think that, I'll make a plug for all my fellow board members in the room here. The MFA is obviously a great organization just in terms of finding out what best practices are, what are your peers doing, challenging yourself in terms of, okay, are we really doing it the best way? Because if you're just internally all sit in a room and everyone agrees that we're doing great things, and you're not really comparing yourself to others and challenging yourself in terms of having mock audits. There's a lot of things that we do to really just keep pushing and making sure that we know the latest and greatest and that we're following best practices.
And has that helped with bringing in new clients and new investors, or just help solidify the reputation in the industry, or do you think that's an industry-wide?
I think it's industry-wide that investors are demanding that, and I think that managers know that it's something that they're going to be graded upon. It's really a check the box. They come in, and if you don't have all the boxes checked, then it's not going to go forward, or they're going to ask a lot of questions, maybe, tell you to change certain things.
So besides from due diligence and transparency, what do you feel like your clients are most concerned about now, and how is Avenue catering to that? Is it the volatility in the markets? Is it lockups, things of that nature?
I think it's across the board. I mean, other than, the operational and the back office, I think that, obviously there is a lot of concern in terms of how do you manage volatility. They want a lot more meetings with your PMs and the investment staff, and they want to understand, I think, on a much more current basis, as opposed to, just once a year at the advisory board meeting or at your annual conference. I think they want access in terms of being able to ask questions and really feel that you're 100% transparent. I mean, I think that's probably the most important thing, and I think that the transparency is really at all levels in terms of your investment style. What are you thinking? What are you thinking for the future? How are you handling the volatility? And the back office as well. And from our perspective, what we do is we have a very large IR staff, and we have someone that's assigned to every single investor. So they feel that it's not just we get your money and then that's it. We'll call you the next time we need some money. But it's a constant process of making them feel that you really are keeping them up to date.
And do you think that process has made the business better?
Yeah,
more efficient?
I think obviously that helps, and it's important, but ultimately it comes down to returns as well. I think that you do have to have the institutional infrastructure, because otherwise, if they can't check the box, then they're not going to be able to invest with you. There's just too many hurdles for, especially the large pensions. They're just not going to go down that road. So it's a combination. I mean, they want to see consistency in performance, and they also want to know that you have the infrastructure.
Speaking of that trend towards institutionalization, hedge funds are bigger than they ever used to be. Do you think you have to be a certain size nowadays to play, or do you think that as firms get bigger, they lose their entrepreneurial spirit?
I think that, to a certain point, you do lose some of it. I mean, it's a lot different when you start and you're 10 people and you grow to hundreds or thousands. But I think it also depends on the culture of the firm. I mean, I think we've tried to keep a lot of that spirit, and a lot of the people that work for us feel that we have. I think the problem in terms of being a small firm these days is that you just can't afford the costs of building the infrastructure. So what we found is we're being approached by a lot of small firms to merge, and I think we're going to see a lot more consolidation in the future, because I think it's not manageable. I don't think that you can be a small firm and just have two guys in the back office and do everything that needs to be done. It's not possible. When we started, it was just Mark and I, and at some point we had 4 people, 5 people, 10 people. You build it slowly, and I think now, I mean, unless you're willing to put a ton of capital into the business on day one, it's just not possible to operate.
Well, do you think that actually benefits the bigger firms? Do you see potentially good opportunities in absorbing smaller firms? Is it easier to get high-quality portfolio managers because the costs of them running their own fund are just too extensive?
Yeah, I mean, I think that there's definitely a lot of people that are looking to do that. From our perspective, it's really, we want to know them very well, because it's reputational risk. I mean, before allowing somebody to merge into your firm, you want to make sure that you know them well enough that they have the same culture, and they're not kind of swinging from the fences or things like that. But I think as a big firm now, there's definitely an advantage, yes.
So Morgan Stanley still has a 15% stake in Avenue Capital. What are the pros and cons of teaming up with a financial institution in this environment?
Well, when we did our deal, it was in 2006. So, obviously in '07, that was when everything was flying high. And for us, it's been a great partnership because they have a minority stake, so they really were not imposing anything on us in terms of any of their rules or their structure. I mean, it was more a partnership to try to grow new businesses, and from our perspective, the cash that we received, we left 100% of it in the business and expanded. So I think that if you have a control partner, I think that's a lot different, but for us it was a great transaction at the time, and obviously in hindsight it was a great transaction because the values have come down a lot. But I think that it also gave us the stamp of approval. I think that, although we had great institutional LPs and there was never, from our perspective, an issue in terms of questioning how do we operate or what have you, when people know that Morgan Stanley has come in and done the full due diligence, top to bottom, we found that gave us an edge in terms of that just added stamp of approval.
So if you could do it again, you definitely would?
Yeah, for us it was a great transaction.
And do you see that potentially as a trend with some of the larger funds, or do you think that the faltering nature in the banking industry right now would kind of prevent that from happening on a broad scale?
Yeah. I don't know that a lot of the banks are really looking to do that right now. I don't think so, and I think that with the valuations where they are, that I don't think many people would actually accept whatever offers are being done. I think that we have to wait and see, and there's a couple people that are potentially going to do IPOs, so we'll see what happens with those too.
All right. And finally, how would you evaluate the distressed opportunities in the environment right now? Some would say that distressed investing is the new little black dress of the investing world. How do you evaluate these opportunities?
Yeah, I think that that's a good point. A lot of people say that they do distressed, and there's a lot of people that go in and out of distressed. And depending on how much opportunity there is, you have a lot of event-driven guys that come in, and they come in at the end of a bankruptcy process, and all of a sudden they're distressed. But in terms of true distressed and having done it for over 20 years, there's probably a handful of people that fall in that category. And in '08, I think that that was kind of a once-in-a-lifetime opportunity, '08, '09. In hindsight, anything you bought then pretty much went up, and now it's, again, we're finding a lot of opportunities. It's more in the middle market names. Mm-hmm. And one thing that never changes is that it's all credit intensive work. It's not something that is an easy market to be in, and we're not investing at the end of the cycle where it's a lot easier to see what's actually going to happen. The plan is filed and restructuring has happened. We get in there at the very beginning, and sometimes the middle, sometimes the end, but mostly we're in there in the beginning of the company actually getting into distress, and then we're part of the restructuring effort. For us, there's always going to be a distressed market because we're following all the companies that are in distress, and sometimes there's less opportunities in the large cap, so we focus on mid cap. There's an '08, there was a lot of large cap. Now it's mostly mid cap. So it's not something that we're in and out of, but you're right. It is sometimes the flavor of the day, and people like to say that they do distressed.
Well, are there any particular regions that you're seeing more opportunities in? So you said that there are more opportunities in mid-cap companies right now, but just globally, is there a particular region where you're seeing?
Well, there's a lot of opportunities in the U.S. right now, and I think that for obvious reasons, there will be a lot of opportunity in Europe. We have a Europe fund that's dedicated specifically to Europe. And right now, we're being patient. I mean, we're buying selectively, but we're not putting a lot of money out because we want to see things at least start to progress in terms of resolving the sovereign debt crisis. But the good thing is that we actually have the cash that's available because we have locked up money. So when we see a little bit of progress, there is definitely opportunity. I mean, everything is at just depressed prices.
Great. Well, thank you so much, Sonia, for joining us.
Thanks.